Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. So today I have a special treat for everybody. And this is going to be a great show as usual, but the guest that we have on today, I think, has a very unique background in that he has been representing buyers and sellers and brokering predominantly multifamily apartment buildings for a very long time. Not only that, but he's also a CCIM, and he serves as a National Council Chair of the Multifamily Properties for Sperry Van Ness International, and he is a senior SVP or a senior vice president, rather, for Sperry Van Ness in Chicago, their commercial real estate group. This is Reid Bennett. So, hey, Reid, welcome to the show, but really excited to have you on and excited to get into this.
Awesome. I appreciate you having me, John.
Yeah, you're very welcome. So let me finish introducing you. There's some more information here that I think is important to share with our audience. So I know you're a licensed managing broker for the Chicago division at Sperry Van Ness, and you're predominantly focused on apartment building sales in the Midwest. And you also have, a pretty good team. Now, it's my understanding, Reid, that, you have clients, all throughout the United States, and you operate in roughly around 150 different submarkets, right? So, yeah. Some of the strengths that you've identified here are, of course, multifamily brokerage, underwriting, multifamily real estate, and then coaching others in the commercial real estate space, which I really appreciate putting that there because I think when you have, a senior broker that also is comfortable teaching people, it usually makes for a very good, buyer-broker relationship, right? Because
Sure.
You can teach the nuances of the market, and I think ultimately owners or principals are paying for expertise. And so you adding that there, I think is great, and I appreciate you doing that. So Reid, talk to us a little bit about how you got started in this space, right? I mean, you've been doing this for a while. You have the opportunity to see transactions and underwrite deals in different states, right? Different submarkets. So you have a very unique perspective. And I think more importantly, you get to work with different owners with different risk tolerances, right? And so that probably adds to the underwriting dynamic that you're doing throughout the nation. So I'm really curious to learn more about that, right? Because you get to see a lot of stuff.
Sure.
So talk to us a little bit about, how you got into this space, and then of course brokerage.
Oh man. Well, once again, I appreciate you for having me on, and it's interesting. I was looking back at a couple of the deals that I've done over the past, and I got into this business in 2020 or 2001. So, it's also interesting that when I got into the business, I was using a digital camera that could only hold 100 pictures on it when I was going out and taking pictures of the properties in my market, which I no longer do anymore. But I started in Chicago with a tiny, almost unknown multifamily brokerage firm. I was the youngest by about 25 years when I came in, so it was a bunch of dinosaurs in the office. And I started in neighborhoods of Chicago, and I started going up and down the streets. And I picked a zip code at a time, and I drive up and down every street in that zip code and cataloged every single apartment building.
Wow.
At that time, it was 12 units and above on the northwest side of Chicago is where I really focused. At that time, when I started the business, 2002, 2003, all the way up to 2007, it was all condo converters buying in my market. So, nobody was making sense of multifamily assets from a management standpoint. It was all, how big are the units? Can I take one of the dining rooms and make them a bedroom? And, so for the first 4 years, maybe 5 years of my career, I didn't even know how to underwrite a deal. All I knew was I'd go in and there were certain buildings where it was such a hot market at the time where owners wouldn't want us going into the units and bothering tenants. So they would take us into the basement and show us where the firewalls are. And, here's where the bedroom is upstairs. Here's where the kitchen is. Here's the bathroom. You can see the stuff, and that's all I needed. Cause then I would just measure that. I had this little laser measure. So I'd have the owner stand there and I'd laser it right into them and write it all down and figure out the unit sizes. Go out, sometimes I had a buyer with me. We'd go out and we'd write a contract on the hood of the car. It was awesome. I mean, it was great. It was great times.
Yeah. No, that's great.
And then that ended, it started to slow down. Pricing got so crazy. I mean, when it was 2007, I was selling deals to condo converters. They were putting on what they were going to make on the back end after all their soft and hard costs and saying, hey kid, put this back on the market at this. And we were getting that price. So I didn't understand that was going to all come to an end and the music was going to stop. At that time I thought I was going to be buying.
You thought the rainbow was going to go forever?
I thought so. I did think that there were not going to be any apartment buildings at all. They were all going to be condos. That's how fast it was going. Wow. I also thought I was going to be paying for my first house in cash because things were going so great. And then 2008 hit. But as right before 2008 hit, I remember I have a client that I still talk to him. He's in his 80s now, but he would tell me about his apartment building in Chicago, and he would pat his front pocket and say, this building gives me, 75,000 cash is what he would say as he fronted it, and I said to him, I said, so 75,000, that's what your cash on cash is. And I said, well, I think your property is worth about $7.5 million. So your cash on cash is horrible. And he was like, oh, I never even thought of that. And so we got him out of that. It was a 60-unit building in Chicago. And we got him, and I found him 2 garden-style apartment complexes it was in Northwest Indiana for $19.5 million. And he tripled the amount of cash he was putting in his pocket. I like it. With no money out of his pocket other than what the proceeds from the property. So that really got me into like, holy cow, I got to figure out how to underwrite these deals a little bit better. So that's when I got into the CCIM program because I didn't really have that background. And CCIM was a fantastic program to go through. Anybody that's interested in it, it's really focused on underwriting not multifamily, any kind of commercial real estate. So, and then from there we got on to I bought into SVN. It used to be called Sperry Van Ness. I have to correct you there.
What is it now?
It's SVN because the two partners split. Yeah,
I remember in my banking days, Sperry Van Ness was all over the place. And
yeah. And it morphed a lot. So I mean, right now, our office is kind of the flagship in Chicago. It's we have 56 agents in the office plus support staff. When it was Sperry Van Ness, it used to be like 1 or 2 person offices that were in secondary and tertiary markets, and now we're in more major markets, and So I took over the National Council Chair of Multifamily Properties in 2013. And so what I do there is I run, it used to be a monthly call. Now it's a quarterly call internally for SVN. And then the thing that I love about SVN is, we're in so many, we're in all the primary markets, but we're in so many secondary and tertiary markets. And a lot of my colleagues in those markets are jack of all trades. So they have to, do all the food groups, office, industrial, retail, multifamily. So some of them don't feel that comfortable underwriting the, 200 unit in their backyard, even though they go to, church with the guy that owns it, or their kids go to school. And so he knows them. Right. But they don't, so they bring in my team and we kind of help them underwrite it. And then we do the marketing, and then we collaborate together. I mean, I don't think there's another commercial real estate firm in the country that collaborates like we do. I mean, we have our national conference coming up in New Mexico in a couple of weeks. And I look forward to meeting, all of my colleagues down there, and we do deal. Everybody's kind of deal junkies and work together. So
yeah, no, that's great. That's great, man. Well, that's really, really great to know. So I have a bunch of questions. I mean, I took already a half page of notes, right? So I'm going to back up a little bit, ask some questions so I can frame some of this stuff out, so that our audience can participate with us in some of the details. Okay.
Okay.
Some of the details, man. All right. So a couple things. Let's start off with the condo conversion. So that happened in 2001 to 2007, 2008. And I remember that, by the way. I started my career in this business in 2008. People thought I was absolutely nuts. That's a whole.
It's the best time to start, man.
Yeah, exactly. That's a whole other story. But it gives you a lot of discipline, when you're starting in chaos. So let's talk a little bit about the conversions, right? Because you mentioned a couple things there that really stood out to me.
Sure.
And that was that at the time, underwriting multifamily properties the way that we do now for cash flow didn't make sense then, right? So investors were buying predominantly to convert those buildings into condos and then reselling them, right, for profit, right?
Yep.
For profit. So how were the dynamics different then relative to how they are today that made the market chase condo conversions versus purchasing for cash flow? Because the valuations are going to change, right? They're going to change a little bit, but I don't think that they're going to change that much. Buyers and sellers are probably paying a premium a little bit, like a slight premium because of the upside on the retail end, right? I mean, you're ultimately reselling to an end user, a residential buyer or a retail buyer. So there has to be a delta there. But man, what was the difference? Why the condo conversions in that market? What was the driving factor there?
Well, I mean, the interest rates at that time were higher. I mean, they were 7%. So, but the main thing that was driving the condo conversions was the fact that was no doc loans and residential mortgages. Right?
Okay, there we go. I forgot about that.
Right. Well, yeah, my brother's he's a residential mortgage broker. He has his own team out in Scottsdale, and he was telling me, back in those days, he would put somebody's income on the form and the underwriter was like, take that out, because if I do that, then I have to verify it. So, I mean, it was just, so that was driving it. So there were so many.
I think you yelled at, man, for trying to be accurate with
Right. Providing data about the person and qualifying them. So that, and I saw that a lot too, was, there were just so many people that were buying condos that, didn't have two nickels to rub together. There's no way they should have qualified for that, but they were giving 110% financing. So I just remember all the people saying, look, I got money back at the closing when I bought this condo and you're still renting an apartment.
Wow.
So, I mean, that had a lot to do with it. But, when you're talking about what the difference is between 2008 and 2022,
right,
the feeling to me is a little bit similar, which is starting to, it scares me a little bit.
Right.
Because we're coming to that point when, I'm talking to a lot of people when we sell a deal and we put out, we just closed this 233 unit deal or whatever. We get people calling back saying, what was the price on that? And, it depends on who the person is. I'll tell them the price and they'll say, how the hell can they afford to pay that? That's what I was hearing in 06, 07, in the first part of 08 is how the hell can that person afford to pay that? And then what we found out in 9 and 10 and 11 is they couldn't afford to pay that because they were all being taken back and the special assets departments were cropping up. I don't know where all those guys went that were running the special assets at the banks.
So here's what's really interesting, right? You talk about there's some parallels in the conversation of finance, right? Between 2001, 2007, 2008. So let's just say there are parallels between 2008 and 2022, and that parallel is in finance, right? Because in 2008, the residential markets were driving the demand for condo conversions.
Yeah.
Right? Because anyone who could fog a mirror could get a loan.
Yeah, right.
In 2020, or let's say 2022 to 2022, really think about it, man, on the agency side, the agencies were driving a lot of that demand because the rates were so low. So it's really interesting that you bring that up, right? I mean, it just goes to show money drives a lot of opportunity, right? The price of money can, drive more deals, or it could slow the market down. And are you seeing that starting to slow down with rates coming up right now, or there's still some pretty good momentum?
No, there's huge momentum in the market. And before I go on to that, I had heard an economist a few years ago talk about lenders have a thing called, I think he called it 7-year amnesia, where they would, they forgot what happened, right, back in 2008. So by 2015, they were lending on pro formas again. And then I think there really hasn't been that kind of a correction. I mean, whoever would have thought a pandemic would make cap rates compress and values go through the roof in multifamily, and industrial especially. But so,
just think about what you just said, right? It's completely counterintuitive, and economically it makes no sense.
Correct.
No sense.
Correct.
Right? I mean, it's totally counterintuitive, breaks every single economic model out there and rule.
Correct.
But yet we're chugging along.
Yeah, we're a 40-year high inflationary period, which a lot of the owners that I'm talking to in multifamily are saying, yeah, my rents are through the roof. And I'm saying, well, have you started looking at what the inflation is going to do to the different line items in your expense column? And we're starting to do inflationary audits for them to show them, look, look what gas is going to do. Look what copper and lumber and all this is going to do to your repair line items and all that kind of stuff. So
how are you coaching them through that, right? So and by the way, genius, brilliant, making an audit call like that, right, to combat inflation. Very smart, man. I think I'm going to borrow that one from you.
Yeah.
So what is the
I can't take ownership of that. That's part of the coaching program that I'm a coach in. We learn this from, all the other coaches and a lot of our clients. And so there's a lot of good information going out there. And that was one of the things that I, really jumped on. And, the other thing that I was going to mention to you is, in the 21 years I've been doing this, I've never seen so many syndicators in the market.
Yeah, so I was going to bring that up, right? Because that's driving a lot of the pricing premiums that we're seeing today. Just think about it. When it's not your own money, you're willing to pay for everything for a fee, right?
Correct.
That's driving a lot of the pricing. No different than in 2008. It was on the residential side. Now we're seeing on the commercial side with non-recourse because it's a fee-driven business now, right?
Right. Well, and I heard one syndicator tell me, he said, if it's a good deal, I buy it. If it's a bad deal, I syndicate it.
But hey, here's the crazy thing though. It's the truth.
Yeah.
I'm seeing a lot of that now. I hate to say this, but I think what's going to happen is, and I already see this right now, it's going to drive more regulatory restrictions, right, in the private placement markets, which is going to be a shame. But this has to slow down somehow, right? I mean,
well, the other thing that, that just came to my mind was, one of the things that we're sharing with a lot of the multifamily owners in this market is, besides the fact that we're telling them, if you didn't take advantage of 2021 and sell, I think 2022 is going to save you because there's still the pent up demand. There's still people that are looking, and they need to invest their capital because, the syndicators, they have to give it back if they don't deploy it. So, but the other thing I'm seeing, especially with the syndicators, is they're using cost segregation. Mm-hmm. And they're using that, the bonus depreciation, the accelerated depreciation to give their investors a bigger return in year one. So, I mean, there's an investor there, or there's a group that I invested with, they were offering, and they put it in their offering memorandum. They're saying, it was $100,000 slots. We're going to give you $82,500 of depreciation year one. So you basically, you don't have that much at risk if you can use that, depreciation on your taxes. So 2022 is the last year of that from the Tax Cuts and Jobs Act of 2017. And then it starts tearing off 20% a year until 2026 when it goes away. Or 2026, I think it's 20%.
It's phasing out. Yeah, it phases out. Yeah.
Yeah. So that's another driver that, I have clients that are, telling me, and they were telling me last year, and I didn't even realize it. I knew I had a bunch of clients that were utilizing cost segregation and getting huge losses when they were getting 30% cash on cash returns. And it's bad. It almost seems illegal. Yeah. But then I really didn't realize it until the last couple of years where I had groups calling me saying, look, we need a deal. That deal that we told you was too expensive. We'll buy it now because we need it for our cost seg for, our tax purposes. Yeah. So it's going to happen this year. If if the sellers want to sell, this is the year to try to take it, because as the interest rates creep up, as these kind of tax deferrals go away, it might normalize.
Okay. So a couple of questions there. So you're trading people out of multifamily assets, and what are you trading them into, right? So they're selling at a good price, right? Yeah. Good demand on the sale side. Yeah. And so the owner liquidates a multifamily asset, a 200 unit asset, has a pretty good gain. And then what are you trading them into?
It depends on where they are in their life, right? So if it's a young guy like you, you're going to be getting back into, you want to get back into the same thing, to me, just maybe a better quality asset, maybe a different area, maybe push your boundaries a little bit, go to a secondary market or even a tertiary market. Where you can, kind of start everything back over again and look for a value add deal. If you're maybe a little bit older and you're tired of the management intensity of multifamily, perhaps you trade out of that into a triple net asset or something with, a coupon clipper. Those are boring to most people though. And then if you don't want to be in real estate at all, or if you want to sit back and wait for things to normalize, because the problem with the 1031 exchange, right, is if you're selling at a 3.5 cap in today's market or a 4 cap, you have to go buy another deal and overextend yourself. So why would you do that when you know the ghost in the closet of your deal right now, is what I hear a lot of people saying. So the other alternative is it's a deferred sales trust. It's section 453 of the IRC.
Very smart, man.
So those things, and those to me, and the way these guys got, I think there are only 8 attorneys that know how to put these together in the country. And the thing about those, and it's not a Delaware statutory trust, although it shares the same acronym, but a deferred sales trust allows these sellers, and I have 2 clients that we just put them together. It allows them to take the proceeds of the sale and even the taxes and the recapture, everything they were going to pay the government, put that into an investment vehicle of their choosing. They direct it.
Right.
And, that generates anywhere from 6 to 9% return. And then you wait. And you wait, because if you find a deal, you can, if you put it up with a qualified intermediary that that understands the concept, you can try to find your 1031 exchange, name it in those 45 days. If you can't do it, you can switch it into this trust. It sits there, generates that income. And then when you find the deal, when everybody starts panicking in 2 years or 3 years, or even if it's 5 years, you find that deal that you want, you borrow up to 75% of your own trust, you put it down as a down payment on that new property, and then there's never a taxable event.
Yeah. But you're still, there's still a tax that's paid on that, right, on an annual basis, because you're stretching that gain out. It's almost like a oh geez, now it just it just slipped my mind. But essentially you're still paying tax on that. You're just deferring the.
Yeah, you're deferring it, but if you utilize those funds to put down another real estate transaction in the future, it just stays there and it defers until you do, it's the swap till you drop concept of 1031 exchanges.
Yeah, no, I get it. I think it's smart. I think it's smart. Right. Are you seeing more of those transactions happening now just because of what's going on in the market?
Yes. Yeah. And because the other thing is we have a ton of clients that, that are older that are saying, look, even if I pass away and my my children get it at the stepped up basis. They don't want anything to do with my apartment buildings. They hated apartment buildings because I was always there. I was always collecting rents, taking calls. They hate my business. Plus, I bought them homes, 4 states away. They don't even live in my state anymore. And even if they get it at the stepped up basis, they're going to just liquidate it as fast as possible and sell it for $10 million less than they should. So the trust, it can flow down to the kids too. And it avoids estate taxes just to a certain extent if it's set up right.
Yeah. Well, I think one of the big opportunities with the deferred sales trust is, liquidating out of real estate and then using those proceeds to buy notes, right? Secured by a first deed of trust. I think that's a pretty good play, and that's where I'm going with that. So we can talk more after the show.
Sure.
All right. So hey, but really, really good commentary there. Some great nuggets there. I'm going to ask you a couple of questions about, and by the way, I didn't know that Sperry Van Ness has moved to a secondary tertiary market type brokerage. I think there's a lot of value in that, man. And that's a really great selling proposition, by the way, because I think there are a lot of good opportunities to be had on the fringes of markets, right?
Sure.
So CCIM, let's talk a little bit about the designation.
Okay.
And you made some remarks that I thought were pretty interesting. You said, hey, look, I didn't know how to underwrite. One of the things that I did is I pursued my CCIM designation. As I went through the program, I learned how to underwrite various types of commercial real estate. So talk a little bit about the designation, what it means to you, what have you gained from it, and then how has it made you better at underwriting deals?
Sure. Well, first of all, the teachers that are in CCIM, they force them to only teach a certain amount of weeks a year. You can't be a lifelong teacher like when you're going to get your real estate license, and those people if you can't teach. CCIM teachers they're out there developing deals, owning deals, running brokerage houses. These guys and girls that are teachers in CCIM are amazing. All my teachers were fantastic, and I still, even after the class, I would, reach out to them if I had a question about underwriting or something, and they would. One guy just did a whole model for me. He's like, "It take me too long to explain it to you. Here's the model," and so
you gotta love that.
And I still talk to. A number of the people that were in my classes, because there are 4 classes. They were week long at the time that I took it. Maybe things have changed online now, but they were a week. You had to carve out a week, Monday through Friday, and take, CCIM 101, 102, 103, and 104. So there are 4 classes. And then at the end of that, you had to put together a book, what they called it, of qualifying experiences. And that was, anywhere from one deal that was over 20 million to, 10 deals that were $1 million, or different kind of things that forced you to know that you were a qualified person to sit for the test.
Right.
So that's kind of the thing, is like, once you get the designation, if there are other people in the business that have that same designation, and many sellers and owners and operators have it. I mean, I know of 3 specific deals that it came down to me and another broker, and the guy said, "You're a CCIM, he's not, you got the deal."
Interesting.
So if to me in this business, if you go through any kind of a class or training or course, and you're saying, "Look, will this get me one deal in my life?" And if your answer is yes, you better be taking that class or course or doing that.
Sure. Okay. So let me ask you the question a little bit differently, because I agree with you. I think there's some I want to use the word some affection there with other broker owners that are selling real estate that have the designation.
Sure.
Naturally, if you have that designation and, they've gone through that experience and they see the value in it, then you're going to be in more demand in their eyes, right?
Sure.
When considering a competitor that's standing to the left or to the right.
Sure.
And now from a professional growth standpoint,
sure.
Right, as you were going through this class, I know things have evolved a little bit. I totally get that. But from a professional development standpoint, if you can point to one thing that you gain from the class that you are able to apply to your days more times than not, what would that one thing be?
I think it would be, we learned buy versus hold. And, I didn't even know what a net present value was before I took the classes because I wasn't a finance major. But the buy versus hold and refinance to me is as a broker, if I'm advising an owner, I mean, most brokers are out there just, hey, what do you want to sell? What do you want to sell? You should only be selling. But to me, to figure out, especially with where the rates are today and the way the appraisals are coming in today, it might not necessarily be the best idea to sell your deal. And to be able to figure out the buy versus hold underwriting, that to me, I think was the kind of the most important thing that I pulled out of those classes was to really understand that concept and be able to model that out for our clients.
Okay, cool. So let's expand upon that because, man, I think that is a great topic. So let's expand upon that. That's a really good one. Completely relevant in today's market. And by the way, I agree with you that it doesn't always make sense to sell. Just because you have the equity and the assets performing well or maybe even performing average doesn't always make sense to sell, right? Because you also have to think about what are you going to sell, what are you going to trade into? And you have to consider the returns that you're going to be generating when you trade up, right? You go, whether you go up, right, or you go lateral, you still have to take into account the returns there, right? Yep. So what is the analysis? Talk us through the analysis. So when you're dealing with an owner, say it's me, right? And you approach me and you say, hey, John, let me take a look at this asset. I'm going to underwrite it, see if it makes sense for you to sell, pull some cash out, or explore some of the other options, right? Sure. Maybe you want to, trade into something else like an industrial asset, single tenant, triple net, right? So you can go hang out in the Bahamas for a couple months or years for that matter. So talk us through that.
Sure. Well, I usually rely, my business partner is a CPA, so I rely on him to do a lot of the underwriting models. Okay. And so we run it through that model. Sometimes, we have a handful of lenders that we work with that we have them underwrite it. What will you lend on this deal? And what will you refinance this property for our client? And so I have the experts do it. I mean, I know how to read them, but I have them underwrite it. And then it gives us the format to sit down and say, look, I think you're best to refinance this deal. This lender will give you a cash out refi. Let's take that money and put that down into another deal or into another investment. Or look, I think it's time to sell this one. It has a bunch of deferred maintenance. You're going to have to start, rolling through the units again. You're going to, your parking lots have holes in them. Do you want to keep, and that's the other thing. And I mean, don't mean to get off topic of that, but, we have a client that is, wanting to get his property in the market. He said, give me until August. I want to, fix a couple doors and fix the parking lots. And I said, look, this is not the time to be doing that. And he said, well, I'm of the mindset you have to wash the car before you sell it. I said, that's not the market right now in 2022. Yeah. People are looking for the value add. So, it totally depends.
Even if the price stripped out all the value, as long as there's perceived value out there, it's like, okay, let's go for it.
It's crazy. And I heard somebody say that, it's like, you brokers, if the property was built, it's a class A deal built in 2022, you're still going to be marketing it as a value add opportunity. So
that's classic, man. That's classic. Hey, so, here's something that I find really interesting, and this might be a tip for you. Yeah. And if it is, then, I'm going to call you and remind you about the best deal that you have so you can refer it my way. But perfect. Here's what's really interesting, right? So, the analysis that you just took us through about pulling cash out and then reinvesting that in something else. So if you do the math on that, right? If you do the math on that and then you account for your cost of capital for the property that you still own, because that's generating a return, right? Over and above your debt service. Otherwise the bank wouldn't have given you the loan or given you the loan, but now you take that cash, you go use it to purchase another asset. It's technically still 100% leverage, man.
Yeah.
So the return is still infinite, right? So
yeah.
when you do that math for a seller, everything magnifies that.
Right.
Yeah. No, I totally get it. I get it. And it makes sense. It makes sense if you can find something that is not as difficult to manage, right? If there's less management associated with the next purchase opportunity, right? Returns are thinner, but better located asset, less management, long-term play. I'll do that all the time.
I mean, it's the term is management intensive. I mean, that's when we see like some guy will say, look, there's 15 shootings in that property in the last 2 years. Yeah, it's a little management intensive. It's always a way to spin.
Just a tiny bit, right?
Right.
Hey man, so that reminds me, I had a property like that I was buying. Where in the heck was this? And the only reason why I remember this because I went to the police station and I pulled a complaints report.
Yeah.
Something didn't make sense. Okay, and it will come to my mind. It was somewhere in Houston. Okay. It was somewhere in Houston. So I go, this doesn't make any sense. So I went to the property. It looked a little rough. I go, I think something's missing here. So I went to the police station, man, and paid for a complaints report. Yeah. Man, the type of complaints that were coming up, shooting, and I did. Oh, I know where it was. It was in Channelview in Houston. That's where it was. Okay. So I got the complaints report, and this thing, man, was no joke. 1 inch thick.
Opportunity all over it.
Yeah, 1 inch thick. But I'll tell you what made me back out of the deal. Okay. I didn't really mind the 1 inch thick, but when I started going through the complaints.
Yeah.
Okay. Shootings. 2 people got shot there. And I go, man, I don't have the time to deal with, this is like a 2-year project. Not where I am right now relative to the other opportunities out there. But here's what really did it for me. So I had someone else behind me who we were walking the property at the same time and they also had a backup offer behind it, right? So they got into their car. I was still walking around. I drove to the other site because there were 2 properties that were relatively close together. When I came back, man, I saw a dude walking around with 2 samurai swords in his back pocket. True story. And I said, okay, not the one for me, not this time.
Wow. Yeah.
He literally walked by me with his buddy, man. And, probably on something, right?
Right. Of
samurai
course.
Swords, man.
Right.
It looked like something out of a Marvel action video.
That's
right.
You see it all in this business. That's for sure. You see it all.
Minus the Marvel action.
Right.
So I said, okay, I got it. I said, I know exactly what I'm buying. And the answer is no. Yeah. So backed out of that. By the way, I do, there was another deal that I called on because I backed out of that deal. So I was driving around and saw a property not too far from there, a little bit better located. So I called the owner and we didn't put a deal together. We almost did. Called the owner directly, but then I called the same guy who bought the property because I wanted to use that property as a comp.
Yeah.
And he didn't seem very happy, man.
Yeah, you know what?
The Marvel action samurai sword.
Dude, I have never heard about the samurai sword before. That's a first. That's a first. But,
well, hey,
I heard one guy say
at the end of our show, Reid, and I'm gonna summarize this. Okay, I'm gonna try to walk through some of the key points that we talked about because, man, there's some $1 million nuggets in here. That I want to thank you for. A lot of great stuff in here, right? So we started off talking about the condo conversions and just some of the parallels in 2008 and 2020, 21. And the big parallel there is financing, right? Residential retail buyer financing, fog and a mirror versus now syndicator financing, fog and a mirror, right? Not recourse. So there's some parallels there. You talked about also just some of the different ways that you approach underwriting, and that it doesn't always make sense to sell.
Right.
Especially if you can pull that cash out, right? Buy something else. that is less management intensive, maybe better located asset because net, you're still right 100% leverage, right?
Yep.
The money's still there. You're just leveraging that into something else that is still going to generate a better return, just less management intensive. So I really like that. And then here's the other thing that I think is really cool. Sperry Van Ness, also in secondary, tertiary markets, man, I think there's a lot of value in that. So I have some market questions that I may reach out and ask you because, I think there's a little niche in those type of markets.
Sure.
And I think that's great that you guys specialize in that. Now, where do you go from here, right? So now you're in a market where admittedly things are, I don't want to say they're still heating up, but things are still hot.
Yeah.
So where do you go from here knowing what we just talked about today, right? How are you advising your clients going forward and where do you see the opportunity?
Well, look, I think there's still a lot of runway left in the multifamily space, especially, to me, the gap between affordability and the market rate deals out there right now, it's widening. So more and more people are being, I guess, constrained into, being renters. And then also you have a ton of people that, the millennials and the baby boomers are all coming back into the multifamily space and becoming renters.
Right.
So I just think those metrics are going to continue to drive real estate, whether or not the cap rates are going to be able to stay at these compressed rates. I think there's going to be a slight correction there.
Yeah, there's going to be some expansion there, especially with rates going up. That's just law of economics, man.
But there's always people that have a reason that they need to sell, and so there's always going to be opportunity for buyers.
Right. So Reid, I have a question for you, bud. You bring up affordable housing communities, right?
Yep.
So there's Section 8, and what is this Section 42 community?
So Section 42 is low-income housing tax credits. And those are many of those properties you would never know if it was a market rate or a light tech deal, as they're called, when you're driving up to them, because you're looking at them. They have a clubhouse, they have a workout facility, they have a pond with a sprinkler. It's just what happened with the low income housing tax credit program allows states fund the developers to develop a nice asset or do what's called an acquisition rehab. And the people that are in there have to be income qualified at 60% or below the area median income. So it's income restricted properties.
Right.
So, in really hot markets, in major metros and, even in some of the secondary and tertiary markets, sometimes maybe the waitress or waiter at Applebee's, can't afford $2,500 to rent. So they'll go, they might qualify for the 60% or below the median area income. So
I know those properties are deed restricted, right? They're deed restricted.
Yeah.
Or affordable.
There's a land use restriction agreement usually that goes with them. And typically, the ones that were built, especially after 1996, were a 15-year initial compliance period and another 15-year extended use. So it's a 30-year affordability. It can be kicked out, on a couple factors, but.
Okay. So 30-year and then the deed restriction gets released.
Yep.
Okay.
Typically. That's just the average typical deal. But, we also see people taking them out of the program. If it's an area that's just gotten really hot, right, they can take it out with, it's called the qualified contract. It takes a couple of years to pull the property out and go back to market rate. But that's an exit strategy for a lot of these owners. And
so what is the owner paying back to the federal government, right? Is there a payback for that, or what's the penalty?
So the tax credits burn off in the first 10 and a half years of ownership. So, they're kind of the motivation for the developers is a pretty substantial developer fee to put this together, because it takes a lot of effort to do this and run through. I mean, just to put together the tax credit application, can cost $75,000, and you don't even know if you're going to get the credits.
Right.
So, there's a lot of risk to it. These developers, they put a lot on the line to build these affordable homes. And you're just saying, what's the play? Like, what's the play after?
Yeah. So, for example, there are two things based on what you just said. There are two things that come to my mind, right? So, say I'm building one of these communities.
Yeah.
Okay. I'm building one of these communities, and the incentive to me as a developer are the tax credits, right? Yeah. So I go through this entire process for the tax credits. And I understand that I have a 30-year tail of deed restriction on this property, right? Meaning I can't go up to market for 30 years unless I take it out of this program.
Correct.
Federal government, I mean, they've been through this song and dance before, right? So they're not going to just let anyone take it out without some form of penalty. Or if you do, you likely have to pay back. If you take it out within that 10-year period, there's some form of penalty, my guess is that happens to keep you in it. And if you get beyond a 10-year, does it still make sense to take it out? Because technically you still have another 20-year tail, right? That you
Correct.
Have to buy.
Well, and oftentimes, depending on where these properties, so owning them for 15 years, which is the first, the compliance period, usually by then you need a rehab again. So many of these groups, it's called a re-syndication. So they'll just run it through the tax credit program again, rehab the units, bring them back up to, today's standards 15 years later, and just put it back in for another 30 years. So it's preserving the affordability for, some of these get rolled over and rolled over and rolled over.
So when you do something like that, are they capitalizing the improvements still and getting the depreciation benefit, or does that revert over to tax credits, or do you get both?
That's a great question. As far as what they're doing in the depreciation, I've never even looked at these deals from the depreciation.
They have to be getting both, man. Otherwise, there'd be no incentive to improve the property, right? There'd be no incentive to improve the property. But then again,
the tax credits they're selling the tax credits in order to get the funds from the state to develop to put into they're not putting their own money into the rehab.
Understood.
Not all of it. Yeah. So, yeah.
Interesting. Well, hey, but I want to thank you for being on.
Yeah, this is fun.
Tremendous guest. Just some great information. And of course, having a great time while you're sharing great information is always a good time. So I want to thank you, man, for being on. Really enjoyed having you. So Reid, what is the one question that you have of me that you think can add some value to our audience? But I've been asking you questions for a good, 40 minutes.
Oh man. I mean, we went over a lot of stuff, today, and way more than I thought we were going to. So, I think the main thing is, first of all, there's nothing like real estate. There's nothing like it. If I have people that trade stocks, friends of mine that do that, and I'm saying, but you can't leverage, 80, 85%, or, 70, 75% of the stock to buy it. So there's just nothing like real estate. I can't even think of what we didn't cover.
Well, what's the one question that you want to ask me?
Well, I would like to understand, with your years in the banking industry, you're obviously utilizing, your expertise and knowledge from that to underwrite your own deals. How are you looking at, new apartment acquisitions or development opportunities?
Yeah, that's a really good question. So I went through this before in 2008. So I kind of had I don't want to say an advantage. That wouldn't be true. But just because I went through this in 2008, I already knew that the markets, right, they were going to shift. Just because we were in maybe a temporary, we were in a temporary market with COVID, right?
Yeah.
And so in 2008, we went through the same thing where everything kind of ran up. And then after that, we started shifting to holding assets for cash flow because the margins compressed. And so the models changed. And so I changed my models. Because of that, right? Now, same thing, except the models now are broken out into three buckets. One is wound up construction, and the other is renovation, And ground up construction, renovation, and then the third would be, long-term hold, man, meaning property doesn't need a lot of improvements.
Leave it.
It's in the path of progress. We're in a really good market, and it's just a long-term play with rents.
Okay.
And so that's in summary, that's how the models have shifted. And the things that have really changed is the model. Well, obviously, ground up construction is very different. That's a unique model in and of itself. But the other two, what changes is how we're underwriting to improvements, right? I mean, that for sure is going to change.
Sure.
And then how we're managing the asset going forward, like the strategy for that and the costs associated with the execution. That's kind of how everything changes.
Well, when you're underwriting your deals, especially the development deals, because you're oftentimes a year to 2 years out of putting a shovel in the ground, right? So what are you doing for your exit cap rates in your underwriting? How are you determining that?
Well, no different than what you're doing now. I mean, you're still benchmarking other assets, right? I mean, you have to have comparables, to your exit, right? When you're selling at reversion, you still have to have some form of benchmark to say, okay, well, if I'm underwriting this asset to, a 2-year hold on the land, right? Because you buy the land, you're going through a development process. If you're in California, it's going to take almost 2 years. If you're in Texas, ideally a lot less than that. But you're say you're one year in on the land, and you're another year in on the actual construction, right? And then you have 6 months of lease up after that.
Yeah.
But if your exit is now another 3 years after the construction, you're still underwriting to an exit cap that you have to benchmark today, right? Even though you're 5 years out. And that's the best that you can do. But the assumptions that you're making, you're saying, okay, well, if today, for example, in San Diego, brand new product like this is trading at like a 2.5 cap because none of that stuff rarely trades. Right. Then if you're underwriting and, your cap rate at cost is 6%, well, man, you're pretty good.
Yeah. Yeah.
You're pretty good. But that's the thing though, right? And that's why the shift, because in high density markets like that, it makes a lot more sense to take on the risk because you have a 400 basis point delta, and that's how you get protected in a market like this. And that's why we started doing ground up stuff, because it just made more sense. You get rewarded for the risk.
Yep.
And you also have more protection because of the density and the delta.
Sure.
Right?
Sure.
So you can afford to make a little bit more mistakes. Now you can't take that out too long. So you have to find ways to mitigate your risk with financing. But if you can mitigate your risk with financing and, you can mitigate your risk on the construction side, then, you're pretty good, man.
Yeah. Well, how can I help you? How can I help you find some deals?
I'll call you after.
Perfect.
After and we'll stay in touch. Yeah.
Perfect.
Yeah. Well, bud, I really appreciate the question. Great question. Hopefully I answered it concisely for you, right?
Yeah. I mean, it's always a challenge to me. And that was one of the things when you're trying to figure out an internal rate of return. To me, the problem in my mind was always, what are you writing it to? I mean, if you're a 5 or 7 year hold, how are you even, you could be 300 basis points off on your exit cap assumptions, depending on what's going on in the nation at that time.
Yeah, you can be. So you talk about an internal rate of return, right? So here's another way that I look at it to simplify it. I look at it more from a viewpoint of the opportunity cost of capital, right?
Okay.
So if I know that my cash flow, my cost of money, if I know that my cost of money is 4%, let's say 6%, right? And my cost of capital is 6%, that's debt. Well, with equity, it's probably going to be a little bit more expensive. So you blend them and you get a pretty decent number, right?
Yep.
But that would be my cost of capital. So anything above that, in theory, would be an opportunity, right?
Okay.
Anything above that cost. But what I have to factor on top of that because now I know what my cost of capital is, right? Yep. And so I have to have a margin on top of that. That would be the next best opportunity that I find. Say I go from 6 to 10.
Okay.
And there's a lot of that stuff out there still.
Yep.
But then now I have to add a risk premium to that for my time, right?
Sure.
And I think that's what people are going to see differently going forward.
Okay.
That's the difference. Yeah. But that's also the opportunity, right? Because everybody's going to view risk differently.
Yep.
And everybody's going to have a different cost of capital. So
absolutely,
you have a lot of people in the middle, and when you can manipulate the bottom end of that and the risk premium, then you're good. There's more opportunity.
Good point. Good point.
So, hey, man, thank you so much. I really appreciate having you. I'll definitely stay in touch, and I want to wish you an amazing journey and continued success.
All right, man. Appreciate it. Thanks, John.
Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.